And let's get more from David Sekera, Chief U.S. Market Strategist from Morningstar. David, thank you very much indeed for joining us.
Of course. Well, the market certainly heard wanted to hear, and I think the way he specified, his quote that the current situation may warrant policy adjustment, market is definitely reading that as he's currently leaning towards a cut in September.
A cut in September, that soon?
Yeah, and I think that's what the market is pricing in right now. We've had, 4 or 5 days in a row of the market declining over the past, week. So I think the market really wanted to hear him intimate to the market that he's leaning towards that cut. Now, having said that, his entire opening was really just outlining the situation, why I think, he's probably damned if he does and damned if he doesn't at this point in time, but he's definitely leaning towards, that cut. Now, we do have PCE coming out next Friday. That's the Fed's favorite inflation measure. We have another payrolls report. We have CPI coming out before the September meeting. So I'm sure he's hoping that the data will, hopefully, for him anyways, provide him the cover for making that cut or not cut at that meeting, that the data would be strong enough, one way or the other. So we'll see what comes out. Morningstar's base case, coming into Jackson Hole was that we were looking for a 25 basis point cut in September and another cut, before year end, most likely in December.
Right. He didn't signal, though, when. You wouldn't really expect him to, but did he provide anything like a clue on the timing? You think he may have implied a September cut is in the cards?
It's always hard to read, between the lines here. But as I was listening to him, it seemed to me that he was intimating that he was leaning more towards a cut in the short term, than trying to wait it out. And when he kind of walks through the dual mandate language, talking about the Fed, trying to promote an environment of maximum sustainable employment, he noted employment was holding steady. But when you look at payrolls for the last 3 to 4 months, especially after the restatements, they've been somewhere between stagnant and lackluster. Our base case here is that the rate of economic growth in the U.S. is going to be slowing for probably the next 3 to 4 quarters. We're still in the no recession camp of really looking at a lot of pressure in the labor markets, over the months ahead. Now, inflation, when he talked about it, he has mentioned that it has started to tick up. However, it still sounds like he's more still leaning towards the camp that while we may get some inflation over the next year coming as tariffs roll through the system, that he doesn't think that that will end up leading towards, long-term inflation expectations rising. So when I kind of weigh those two factors and the way he characterized it, it sounds to me like he's leaning more towards that cut in September.
Maybe we'll just very briefly put up an intraday for the S&P 500 again, and maybe an intraday for the NASDAQ 100. Thanks, Control Room. Yes, certainly higher shortly after 10 a.m. So the market, as you say, appears to have heard what it wanted to hear. You have a couple of interesting stock ideas for us. Talk to us about Walmart. You don't like the look of that stock right now.
Yeah, we think Walmart is overvalued at this point in time, and in fact, very significantly overvalued. It's a 1-star rated stock, putting in the category that we think it's significantly overvalued. When I look at the results that came out the other day, they did beat on the top line, but they missed their earnings expectations. So I think that's just showing that they are eating some of the tariffs here. So when we think about our long-term forecast, we think the market's just over-extrapolating, too much earnings growth too far into the future. And for a company that trades at 38 times, forward PE, I still see a long way for that stock to continue to correct to the downside.
Palantir, the short sellers have been battered by this one this year. Over the past week, they've had a bit of relief. You think Palantir doesn't have much upside right now?
Yeah, that's a 2-star rated stock, trades at over a 30% premium to our fair value, even after as much as it's come down over the past week or two. And really, when I look at this one, I think the market, again, is just over extrapolating too much growth too far into the future. I opened up our model. Our 5-year compound annual growth rate for revenue is over 40%. So we're modeling in revenue to grow from $4.2 billion this year all the way up to $16 billion in 2029. Our 5-year compound annual growth rate for earnings over that time period period is 61%. So we're looking for EPS to go from 63 cents this year all the way up to $2.20. But yet that stock is trading at, I think, like 100 times revenue, trades at 289 times our 2025 earnings. And if our base case is right and those play out, you're still paying 83 times 2029 earnings. So I think there's just way too much priced into that stock at this point in time.
David, we better leave it there. Thank you very much indeed for joining us.
Thank you.
David Sekera, Chief U.S. Market Strategist for Morningstar.